Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing SCWorx's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. SCWorx is a big data play on the healthcare sector. It also supplies COVID test kits, masks, gloves, and shields. The rise of COVID-19 variants have brought more attention to healthcare and protective equipment providers. This company has developed healthcare information technology solutions and services that improve processes and information flow within hospitals and other healthcare facilities. Its software enables a healthcare provider to simplify and organize its data to be utilized across multiple internal software applications, which is also known as interoperability. And it also provides the basis for sophisticated data analytics. That's also known as big data. The software is used to reduce supply chain costs, decrease accounts receivables aging, contract optimization, and much more. Its customers include some of the most well-known healthcare organizations in the US. The company is headquartered in New York, and was founded in 2012. It started trading in 2019 and can be found on the Nasdaq, Deutsche Börse, and Börse Stuttgart. The stock price more than doubled the first week of August. It appears the surge was due to a short squeeze. The short interest was as high as 58% at one point. Some articles claim the short interest was up to 75%, but I'm unable to verify that. On February 1st, 2019, Alliance MMA completed the acquisition of SCWorx, changed its name to SCWorx Corp., and also changed its ticker symbol to WORX. It also did a 1-for-19 reverse stock split of its common stock, which combined the 100 million Alliance shares of common stock into 5.3 million shares of common stock of the newly combined company. In April 2020, the company announced a purchase order from Rethink My Healthcare for 2 million COVID-19 rapid testing kits and additional weekly orders of 2 million units for 23 weeks. This contract was valued at $35 million per week. Later that month, Hindenburg Research issued a report casting doubt on the deal, calling it completely bogus, that the test supplier was laden with red flags, and that the CEO falsified his medical credentials. Then the SEC suspended trading on SCWorx because of questions and concerns regarding the accuracy of publicly available information of its press releases and 8K filings. So the SEC suspended trading on this stock because they questioned the validity of the agreements for this company to sell COVID-19 tests. On April 30th, 2020, this company terminated the purchase order for the COVID-19 test kits and future orders. Also, SCWorx has been sued in a securities class action lawsuit for failing to disclose material information and violating federal securities law. Let's get started with the model. This is a microcap company, 30 million market cap. They're trading at $3 a share, and they have 10 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they do have negative free cash flow each year because they're not bringing in much revenue at this point. Net income is the profit or loss on the income statement. It's revenue minus expenses, which is also negative every year. Revenue is the sales for the company, and that grew from $200,000 in 2018 to $6 million in 2019, but it dropped a little in 2020 and the trailing 12 months. This is the company's income statement. The top line is the revenue, the sales. So it does look really good that their revenue jumped a lot from $150,000 to $5.5 million. But in 2020, you would have expected their revenue to increase a lot due to their relationship with COVID and the testing kits, the masks and gloves. But it hasn't. It actually dropped to $5.2 million. Also $5.2 million in the trailing 12 months. Below revenue is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit. They do have positive gross profit, but their operating expenses are pretty high because a company like this spends a lot in research and development, so they have negative operating income every year. So of course they have negative net income as well. So in 2020, they posted a $7.4 million loss. In the trailing 12 months, they posted a $7 million loss. Let's look at the statement of cash flows. So you can see on the statement of cash flows, even though they reported a $7 million loss, they actually lost only $1 million of cash because the top line operating cash flow is how much cash the company loses from its operational business. You could think of this as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. There are a lot of non-cash items that get passed through onto the income statement that bring down your net income, but they don't affect cash flow. So that is a positive sign that they're only losing $1 million. In prior years, they were losing $4 and $5 million. And they don't spend too much in CapEx since it's mainly research and development. Operating cash flow minus CapEx give you your free cash flow, and they do have negative free cash flow every year. They're mainly running their business on selling capital stock. They issued $2 million in 2017 and $7.5 million in 2018. They did add $1.6 million of debt in 2018 and a little bit in 2019 and 20. This is the equity section of their balance sheet, and they have $6 million of equity. So they raised $27 million from selling stock, and they lost $21 million from operating their business. This is their total losses since they started as a business. So if they lose another $6 million from running their business, they will be insolvent, unless of course they can raise more capital. Let's look at the capital structure. They have $5.7 million of equity, $400,000 of debt. So they're 93% equity, 7% debt. And their weighted average cost of capital is 11.57%. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year for, that's $49 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $30 million. We divide that by 10 million shares. And we get a calculated stock price of $2.99. So I didn't really value this stock because it was too difficult. So I'm just showing you how much their free cash flows would need to be to justify a $2.99 stock price. So if they still have negative free cash flow until 2023, then have positive in 2024, they would need to generate $4.3 million of cash flow to justify their current stock price. On average, a company converts 10% of its revenue into free cash flow. So that would mean they would need $43 million of revenue by 2024 for the stock price to be worth $2.99. This is where the stock has been trading the last 12 months. So you can see there was a short squeeze recently and the stock got to its highest point. When a stock is driven up really quickly, there's usually a sell-off because people want to take in their gains and the stock price comes down. But it's still trading higher than it was before the short squeeze. This is a really volatile stock. It has a beta of 3.52. That means the stock moves 3.5 times the market. If a stock had a beta of 1, that means the stock moves with the S&P 500. This company moves 3.5 times the S&P 500. So in theory, if the S&P 500 went up 2%, this stock should go up 7%. And if it went down 2%, this stock should go down 7%. This company has done better than the S&P 500 the past 52 weeks, up 55%. The S&P 500 is only up 31%. The 52-week low is $1, the high is $5. I'm curious if these numbers are correct because they're exactly $1 and exactly $5. That is a little weird. It's usually like $1.02 or maybe 97 cents. Not exactly $1. The stock is currently trading well above its 50-day and 200-day moving average. And this is a really popular stock. 31 million shares are traded on average the past 10 days. Of the 10 million shares outstanding, 7.8 million are on float. 3.25% are held by institutions. And according to Yahoo Finance, 5.5% of the shares on float are shorted. But I thought the short percentage was much higher. That's a hard part about investing is you rely on these companies like Yahoo Finance or Seeking Alpha to provide you information, but you're not sure if the information is correct because it conflicts between different websites. So the stock has done really well the past 90 days, up over 120%. It's still doing better in the past year, better than the industry and the market. 4 of the 5 biggest shareholders are directors of the company. Timothy Hannibal is a CEO and president. Let's look at their financial ratios. They have negative net income, so we can't look at the PE. Their price to sales ratio isn't too bad. It's 5.7, which is between the market median and market average. They do have low revenue, but their market cap is really low as well. So that's why their ratio isn't so bad. Their price to book is pretty good at 5.2, but almost all their assets are intangibles. They have 10.6 million of assets, 8.4 million is goodwill. Goodwill is a worthless asset. You can't do anything with it. And people usually invest in a company so they can generate profits, not sell their assets. But it can be helpful to have assets on your balance sheet that have value, like equipment and buildings, because it could prove to be helpful in some situations to sell those assets or put a lien against those assets if you need quick cash. And they have a low current ratio and low quick ratio, so they cannot cover their current liabilities with their current assets. They have less than $100,000 of cash on their latest balance sheet. This does indicate they may need to take on some debt or equity over the next 12 months to fund their current liabilities. If they're unable to do that, they may be forced into bankruptcy. The best way to look at ratios to compare them to companies in the same industry. I've done videos of 6 other companies in the same industry as SCWorx, and if SC has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So most companies in this industry don't have a PE ratio because they have negative earnings. And you can't really have a negative PE ratio. It really doesn't make sense. Because generally speaking, the lower the PE ratio, the better. For example, if a stock had a PE ratio of 10, that's considered a better value than if a stock had a PE ratio of 50. PE ratio is market cap over net income. So you can calculate it. It would be a negative PE ratio for SCWorx since they have negative net income. Since the lower the PE ratio, the better, a negative PE ratio would be amazing. But that's not the case. A negative PE ratio is bad. That's why we put NA. But if a company has negative ROE, we'll put that because the lower the worse for the ROE, the higher the better. They do have a better price to sales and price to book than their industry. They have a bad current ratio and ROE. They're low in debt. The main reason is because it's difficult for them to obtain debt financing since they're such a high credit risk. And they have the lowest market cap by far. CloudMD, when I convert their market cap to US dollars, is 10 times as large as SCWorx. And CloudMD has a really small market cap. So to summarize, it does seem like a risky stock. And if you are bullish, then you could get this stock at a really great value because the market cap is so low at this point. But I think a lot of people are treating it as a meme stock. They're just buying it and hope other people buy it and push the price higher and then sell it when it's high. I don't think too many people are looking at this stock as a long-term play. But if you are thinking that, leave a comment and let me know why. I rank their free cash flows 1 out of 10, their revenue 1 out of 10, and their ratios 2 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.